Hello, my name is Brian Bartow, and I am an enrolled agent with Tax Debt Resolution Services of Winchester, Virginia. I'm the owner and founder of Tax Debt Resolution Services. And so you owe some back taxes. Okay, so the question on everyone's mind if you owe back taxes is how much am I going to have to pay to get the IRS off my back and to get this thing squared away? So how much does the IRS expect me to pay? All right, so the IRS uses a formula called the reasonable collection potential. And in the tax resolution world, we just call it RCP. Okay, so the reasonable collection potential is going to be based on your financial situation, your income, your expenses, as well as your net equity in assets. And I'm going to talk a little bit more about each one of those here in a second. Okay, so when is RCP used? All right. So if you have back tax debt and you wish to establish an installment agreement, a payment plan, for example, um, the IRS will use the RCP in order to determine how much they'll accept in monthly payments. If you apply for an offer in compromise, which is when you offer to pay the government less than the total debt owed, they will also use the same formula, the reasonable collection potential. Okay, so again, how is the reasonable collection potential calculated? Okay, as far as income goes, it's important to note that the IRS for IRS purposes, your income is not based on taxable income from your tax return, for example, but rather it's based on cash flow from all sources. So, for example, sources such as child support payments you receive, or alimony, or the non-taxable portion of Social Security income, dividends, interest, or pension distributions, just to name a few. All of that is taken into account to calculate your RCP. Okay, so now when we talk about expenses, it's important to note that the IRS will not necessarily allow you to claim all of your actual expenses. Certain expenses have national standards or local standards according to guidance that's published by the IRS and updated annually. For example, there's a local standard for housing and utilities, and that's going to be based on family size and where you live within the country. When calculating, for example, when calculating the RCP for housing, the IRS is going to allow you the lesser of the actual expenses, what you're actually paying, or the local standard amount. Now, there's other standards that are national standards, such as there's one called food, clothing, and miscellaneous items. That's a national standard. And there's also a national standard for automobile ownership expenses. Okay. All right. So net equity and assets. The easiest way I found to think about that is what would the IRS get if it foreclosed on its lien, sold everything at quick sale value, which is 80%, paid off any loans that you had that are ahead of its lien, and took the net equity. Okay, that's what the RCP is for assets, and that's what the IRS would expect you to be able to pay. Essentially, the IRS expects you to sell some assets in order to pay back your debt. Okay, so that in a nutshell is the reasonable collection potential, and a good tax professional who clearly understands the IRS rules, the expense standards, how to calculate the future income, and how much future income to use in the calculation, and how to manipulate some assets around perhaps, and there are definitely some strategies to increase your chances of success of getting a especially an offer in compromise approved, as well as offering the lowest possible amount on your installment agreement. Okay, so if you have any questions and want to discuss anything, my contact information is right there. Feel free to reach out, and have a great day, and thank you very much for listening in today.